Warren Buffett explains how long can stocks stay overpriced before a crash. Hello and welcome back to Wealth-ology. For today's video, we will be going to talk about Warren Buffett's explanation of how long can stocks stay overpriced before a crash. Let's get started. The stock market has rebounded from its crash in 2020 and soared to new highs. The SP 500 is well above 4,000, the highest it's ever been in history. But the question is, how long can we maintain these ridiculously high stock prices before we see a crash? Let's go to the world's greatest investor, Warren Buffett. See what he has to say. So GDP per capita is the 20th century in the United States. Went up 610%. Actually, qualitatively, it went up far more than that because you can't really measure, certain things in medicine or whatever it may be and improvements. But just on a quantitative basis, it went up every single decade, including the decade of the 30s. So you had 100 years when basically the US citizenry was improving their lot decade by decade. By decade, the 30s, it was up 13%. Best decade was World War II in the 1940s. It's up 36%. The worst decade was the First World War. So you get sometimes the analogy, you can get in trouble on analogies. But in any event, it was a huge period. Interestingly enough, there were three big bull markets from 1900s to 1921. The Dow went from 66 to 71, less than a 10% move in 20 years, less than half a percent a year. You got dividends too, but a half, so it didn't move from 21 to 29 as you point out. It went from 71 to a high of 381 in September of 1929. Went up 500%. Well, obviously, the well-being of the country didn't go up 500 during that period, and the well-being of the country went up a whole lot more than 10% during that first 21 years. So we got this very uneven development from September 1929 until the end of 1948. The Dow went from 381 to about 180, was cut in half, and that was 18 long years, and yet the per capita GDP was moving right up during the whole period. So the economy was doing fine from 48 to 65. The Dow went again from about 180 up to close to 1,000 again, 5 for 1, which was far outstripping it from 65 to 81. The Dow went down, literally. Well, again, per Vita GDP, and then we've had this last period where it's gone up terrifically. If you take the whole 100 years, it went up 180 for 1 every $1,000, become 180,000. But 43 and a quarter year, 43 and 3/4 years were those three big, huge bull markets, and 56 and a quarter year were periods of stagnation, all in an economy that was doing fine. 5 year after year, 56 and a quarter year net, and Dow was down a couple hundred points during that period, and the other 43 and 3/4 years made up the rest of this, moved from 66 to 11,000, some on the Dow. So you say to yourself, how could it be that you could have a country that was doing better and better and better and better? Citizens were living, every generation was living better than one that preceded it. But you had these huge changes, big gains a few times, long periods of stagnation, 20 years I mean. That's a long time to do nothing. The answer is that investors behave in very human ways, which is they get very excited during bull markets, and they look in the rear view mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow. Or the neighbor says, I wasn't in last year when that neighbor was dumber. Then I made a lot of money. So I'm going to go in this year. So I always look in the rear view mirror. And when they look in the rear view mirror and they see a lot of money having been made in the last few years, they blow in and they just push and push and push on prices. And when they look in the rear view mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business, and it's outstanding. But that makes for a huge opportunity. Just huge opportunity. I mean, I've lived through roughly half in an investing sense, about half that period. And I've had that long period of stagnation from 48. I mean, from 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in the 1970 put 100 and some percent of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in 9% of their net new money. And in 1978, when stocks were way cheaper, people behaved very peculiarly in terms of the reactions because they're human beings and they get excited when others get excited. They get greedy. When others get greedy, they get fearful. When others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime, and securities markets, and the country will do very well over time. But you will see these huge waves, and if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich and you won't have to be very bright. I mean, I'm sure you are, but you know it. Just it doesn't take brains. It takes temperament. It takes the ability to sit there and look at something. When I started out in 1950, I would go through and find things and 2 times earnings, and they were perfectly decent businesses, and people wanted jobs in those companies, and everybody knew that we're going to be around. And they wouldn't buy them at 2 times earning, and that's when interest rates were 2.5%. I started selling securities when I was 21, and a Kansas City life insurance company happened to be a fairly prominent company in Omaha, and the policies they sold if you were buying life insurance from them had a built-in assumption of 2% interest. The stock of Kansas City's life was selling at less than 3 times earning. You're getting 35 if you bought the stock. No question about the soundness of the company. I went to the local agent. I thought I figured, hell, I'll be able to sell him a few shares of stock. I mean, the guy would understand him. He's got the whole life invested in this company. I went the local agent who'd been with him for 20 years and asked his name was Moose. I said, Mr. Moose, you're selling these policies with 2%. You may even have a few on members of your own family, and you can buy into this company, whose payback you depends on every month. And whose future your beneficiaries of these life policies depend on, and who you're selling them, 2% investment on, and you get 35% of your own money. Yeah, stocks aren't any good, and I couldn't sell. I was a lousy salesman. I mean, well, you have to start with that. But it just blew me away. It blew me away. I thought sometimes I used to wonder if I was nuts, but those things, the same thing happened. I mean, in 1964, the Dow closed at 864 at the end of 1981. 17 years later, it closed at 8.65. It moved 1 point in 17 years now. That's not a big move that you can't believe. The how discouraged people were by that during that period. But people are living better. So things can go on a long time that don't make sense. But they do come to an end. I mean, the internet thing, I mean, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herbstein one time said anything that can't go on forever will end. Now that's incredible. But think about that, particularly think about it next time. You're trying to do something just because the stock's gone up a whole lot, and your neighbors made money or something. You've got to be you. Just have to sit and think objectively and think about, would I buy this whole business? It's an internet companies. Got 100 million shares out of selling 100. That's $10 billion. Is it worth 10 billion? If it's worth $10 billion, it's got to be able to give you, 7 or 800 million next year. And if it doesn't give you 7 or 800 million next year, it has to give you maybe 10% more than that the year after, and continue to. There aren't a lot of businesses that can do that, and people just go crazy. And of course, it's fun. I mean, it's like the sign they put in the brokerage offices that says, avoid hangovers, stay drunk. It's just so much fun to keep playing. But you gotta do sensible things to get good results. So which of Warren Buffett's explanation did you find particularly helpful? Please let me know in the comment section below. And if you like this video, please give it a thumbs up. Turn on the notification bell and subscribe to our channel for more. Thank you for taking the time to watch. Stay tuned for our next video.